Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Jim, thanks so much for joining us today.
Hey, thanks for having me, Adam.
What is your current assessment of today's economy and financial markets?
I think a lot of people are hopeful that inflation has peaked. I agree that it has peaked, but I also think that that's not the right question to be asking. The right question to be asking is, how far down is it going to go? The hopeful crowd thinks it's going to go back to 2%. That means the Fed can stop raising rates, and maybe we could even start talking in the second half of 2023 about them cutting rates. And that's got financial markets, mainly the stock market, excited in the last few days. I'm of the opinion that it's not going to go down that far. It's going to go down to maybe 4%, and that the Fed raising rates to somewhere near 5% only gets you back to neutral. And at some point, there will be a movement to get the Fed to actual restrictive territory. And when we do that, I suspect then we'll get that recession that everybody has been forecasting to happen in 2023.
Real quick, do you have anything else to say just to help people understand sort of what FTX's role is? And there's a hedge fund arm called Alameda Research that was part of this whole thing.
It is a failure of the types that we saw in the 30s, in the bank runs in the 30s. It is, or we saw in 2008, we saw in 2011, MF Global, or even to some extent, a little bit in 2020. That's not new. What is new is the space that it came in on. And lastly, you mentioned the FTT token. What that was that they created their own printing press. Is what they did was they issued their own token. They then transferred a bunch of those tokens to Alameda Research. Alameda used those as collateral to take out loans for more legitimate tokens like Bitcoin or Ethereum or USDC Circle, the stable coin. And they were basically, like I said, we're creating these tokens out of thin air and using them as collateral for other loans. That is a big red flag. That should have never happened in the first place. That might be unique to the crypto space. You and me, at last count, we're still not allowed to have a printing press in our basement.
Begs the question of like, oh my God, how did this even how do people give these guys money? Because I mean, Sam Bankman-Fried, I mean, he attracted an awful lot of outside capital in as investors, right? Really big names.
In the beginning, when he created Alameda Research, he was doing a bunch of crypto trade. He discovered that there was a way that he could buy Bitcoin in the United States and sell it in Japan for as much as a 10% difference. As the folklore goes, when he first started doing this trade in 2017, he was doing it with like $200 a day of his own money. Within 3 months, he was up to $10 million a day. This is how profitable this trade was. So he kind of got this mystique about him as being this brilliant type of trader that made all this money. And he did. He made a lot of money legitimately.
Okay.
And then
do we really think that he discovered this arbitrage and that it lasted long enough for him to really make this kind of money?
I think we do, because the arbitrage had a number of barriers of entry. You had to open up an account in Japan, you had to have an account in the US, you had to transfer the coins. And he went through an enormous amount of effort to try and put all the pieces in place. This was not something that you or I could have done in 2017. Hey, on this account here, buy some Bitcoin, transfer it to this account here, sell it in Japan at 10%. It was a lot more involved than that. So let's understand that at every one of these things, you start with somebody that did something legitimately and got rewarded for it big. And that's what he did.
Okay. And let's just scope this. So in terms of the client assets that are at risk here, what are we talking about? Billions, tens of billions?
Yeah, somewhere around 10 to $14 billion.
I saw something this morning that CZ announced that Binance was starting some sort of fund to
a rescue fund or something like that.
Yeah,
yes.
Exactly. And basically inviting the rest of the ecosystem to come in and join it, right? So we'll see what the pickup of that is. We'll see if it'll be enough to make a difference, but it's being done for the exact reason you just mentioned there, is there's no lender of last resort currently in that marketplace to try to help stem the contagion effect that everybody's worried about.
It's not a bad idea by itself. It's just, what are the details? And does that expand to centralized exchanges? If another centralized exchange fails, are they going to put together some kind of insurance fund for them? We'll have to see what he suggests.
Do you think this is a permanent setback that like institutional capital is never going to come into the space? I'm not saying that's what you're saying. I'm just asking if you think that's a risk here. And if you don't, if you think it's eventually dust will settle and folks will begin to stick their toes back in, how many years back do you think this may be setting things?
All right, so I don't think it's permanent, but I do think that what the industry has to do to get its reputation back and to get its capital back is it's going to have to completely reorient itself. Let's get back to creating a new type of financial system. If they do that, the institutional money and interest will return. But if they want to promote themselves as being Vegas, but Vegas on steroids, the money's not going to be anywhere near them if they're going to continue to promote it in that way.
Okay. I'm getting a little bit ahead of my questions here, but do you feel then that we almost need even more of a reckoning to come through the crypto space here to really clean out the hucksters, the shysters, the casino believers that remain in terms of, hey, let's get back to building the basics of the better system that we were hoping to do?
A lot of these hacks are largely because of that. These developers, again, it's the mentality of the casino. We got to get it out the door because then our coins will go up and we'll all become rich. Oh, but it's not ready. But if we waste more time, it's profit opportunity. Well, once the mania is gone, it's about the only way we're going to be good or the only way we're going to make money is if what we do is good, not first. And so, yes, it's going to take some time to get rid of all of this. And it's going to be painful. And maybe the winter, as they call it, bear market, might turn into an ice age. Cryptocurrencies and decentralized finance had a promise that it was going to be the answer and then lost its way. If it can refocus itself on disrupting the financial system, it's got a chance of really becoming something important from here. But if they want to continue to be a casino, I think it will fail. I don't think it will be a casino. I think those people are going to be driven out. And I think it's going to become more of let's rebuild the financial system instead of let's pump a token and become rich by tomorrow.
FTX had bought one of these struggling crypto firms because it had some sort of waiver on some sort of requirement. And the hope was that FTX, by acquiring this struggling company, would then get the protections of that same waiver, giving it an industry advantage. Who knows what was going on there?
That was Celsius that they were trying to get, that had a waiver on being able to do business without having a specific type of registration. And he wanted to, by buying them, hopefully extend it to his larger organization as well, too. Yeah, no, Gary Gensler, was very close with them, was slow walking the regulation. It could be argued that in the specifics, you set up a regulatory arbitrage. That these U.S. regulated, and let's be clear here about this, the U.S. regulated exchanges, not only FTX US, Binance US, Coinbase, which everybody knows about, Kraken, Gemini, there's no problems there. There's no one's alleging problems because they have to adhere to SEC rules the same way, as I said, like Fidelity or Schwab do. They're under the same set of rules. And there isn't any problem there. But then they got these offshore exchanges, and these offshore exchanges can do things that the U.S. exchanges can't. They can offer to the customers better deals. Better deals tends to be, in the case of interest rates, deposit your coins with us and we'll give you a 30% yield. How the hell did they give you a 30% yield? Because they were paying you with other people's coins, otherwise known as a Ponzi scheme. If you tried to do that in a regulated U.S. exchange, everybody goes to jail. But if you do that in an outside exchange, no one is regulating them.